So good evening once again. So we have two parts to this session. The first part is to discuss on risk management, and the second part will be to review the setup we took in the course of the week. So in discussing risk management strategy with you, I'm going to use a model. I'm going to use a model of $200 as equity balance. Okay, so as I discussed with you before, there's what is called maximum daily risk exposure. Maximum daily risk exposure limit. Okay, maximum daily risk exposure limit. This is what has been my guiding principle, and nobody adopt this particular model that ever fail in this business or that ever waste his account. Your account might be dropping, but you are not going to have a lost account. It's not going to be possible. Maximum daily risk exposure limit. Okay, what do we mean by maximum daily risk exposure limit? This is the maximum amount in terms of dollar value or in terms of percentage of your account that you are willing to expose to the market in a day. This is fundamentally different from what you have in the capital market. In the capital market, there is nothing like maximum daily risk exposure limit, because you have bought and then they trade your share. If you lose 50% of your portfolio, it can go that day. But this one in forex market, you have control over your money and you can decide to set maximum daily risk exposure limit. Okay, that's the maximum amount you are willing to risk of your capital in a day. It can be in terms of dollar value and it can be in terms of what? Percentage. You can use any of the two. It's cool. But myself, I use percentage. All right. So if I have a $200 account, I'm willing to expose just $10. Just 10% rather. It's 10%. I use percentage. I don't use dollar. 10%. I'm willing to expose 10% of this account to the market, and 10% of 5%. Pardon me, pardon my mistake, please. 5%. I'm willing to expose 5% of this account to the market. Remember, this exposure is different from risk. Although it's risk, but the probability of you losing the 5% you are exposing to the market today, it's not there. So the fact that this is your maximum daily risk exposure limit does not mean you are going to lose all this money to the market. No, this is to permit you to plan your capital appropriately. And then 5% of $200 is going to be how much? $10. Going to be what? $10. Meaning, if you are having a $200 account, you are going to permit risk of $10 in a day. So for people who have small accounts and who do not have anybody or any mentor that is guiding them in the choice of the trade they are going to be taking, I always recommend to them that they should only trade the London, New York overlap, where you have adequate liquidity and proper setup, where they could well utilize or efficiently utilize their maximum daily risk exposure money. All right, they can efficiently utilize it in London, New York overlap. Okay, so now let's give an example that you have a trade Euro AUD. This Euro AUD now the setup comes. Remember, the whole amount you are willing to risk in a day to expose to the market in a day is $10. You don't want to put all these $10 on one single trade, guys. You don't want to do that. You want to put it on 2 trades. All right. So the first setup that comes to you is Euro or. So you now decide to say, okay, I'm going to risk $5 on Euro or. Okay. And this $5 you risk, guy, you get break even. It means you were in profit, and as soon as you are in profit, you now remove your stop loss and now shift your stop loss to the entry price. So when the market came back against you, you neither lost, you neither gained. So your capital remained the same. So you can see that you have taken the first trade, and despite the fact that you have taken the first trade, your maximum risk exposure limit still remain $10 because you didn't lose anything here. You didn't lose anything here. Is that okay now? So you go for trade 2, which is card yen, card JPY setup. So this card JPY setup, you took it and you risk your $5. Remember, you still have $10 available for you, but you don't want to use everything in one trade. You use $5, and when you get $5, you now get what is called 1:5 risk to reward. 1:5 risk to reward. This one is the same thing as this $5, guys. The same thing as this $5. Okay. Then this 5 means that you have won 5 times 5, which is 25. So it means 1:5 risk to reward is $25, guys. $25. And you see, this is second trade, you won it, $25. So now there is the risk maximum risk exposure limit is dynamic. So this $5 you have won, you are going to add it, $25, you are going to add it to 200. Your equity has now increased to $225, guys. It means that since you have won this trade, your maximum daily risk exposure limit has also increased because you're going to get 5% of this amount, guys. What is the answer? 5% is what? Is it $12? 5% of 225 is what?
It's 11.25.
11.25.
11.25, sir.
All right. So this is the maximum daily exposure limit that you have. And it has gone up because you won this trade. So maybe the third trade, you now go for GBP, USD. You see the setup there? You take it. So as you take it, you now get break even. So as you get break even, you have done 3 trades in a day. Guys, it's enough for you. You have to take a break, right? Because the time you are taking to analyze and to observe and to take this trade, London, New York overlap will have been over. So taking 3 trades in a day is very okay and appropriate. You don't need to take 4 trades, 5 trades, 6 trades in a day. And that's a scalper, guys. Only scalpers do that. So once you have taken 3 trades, one break even, two break even, one win with 1 to 5 risk to reward. You know why you have to take a break, guys? If you don't take a break and you go for the 4th trade, that's the one you're going to lose. And when you are going to lose that one, you're going to lose your $25, guys. You remain to the same position. So once you have taken a good win of 1:5, you just take a break for that day. You come the next day again. Remember, your maximum daily risk exposure limit for day 2, guys, still remain 11.25. Maybe the first trade you take, guys, you lost by 1:1. That is, you risk 1, you lost 1. All right, you risk 1, you lost 1. So what did you risk? 11.25 divided by 2. That is let's say $5. Okay, that's what you have lost now. What are you going to do, guys? I'm going to minus $5 from your $225, guys. So the answer is going to be $220. Okay, so you're going to find 5% of $220. So 5% of $220 is what, guys? 11. Let's just say it's 11. All right, let's just say it's $11. Okay, all right. So this $11 now is your maximum daily risk exposure limit. So if you divide it by 2, you get 5.5. So the next trade you are going to take, you take it and you won it by 1:2. That is what you risk $5.5. You now got 1:2, meaning that you have won $11. So this $11 again, guys, you are going to add it to what? 220. 220. 220 plus 11. Because you did 1:2, and that is what? 231 US dollar. So what are you going to do next? You know the procedure. Times what? 5 divided by 100. It's going to give you, let's say, $13. So your maximum daily exposure limit has gone to $13. So $13, you can divide it by 3, guys. So let's say per trade, you are going to reach 4%. 4%, another trade 5%, another trade 4%. Okay, 4%. Can you see? 3 trades. You are going to spread it. So maybe the one you reach 4%, you know, that 4%, that is $4, guy. $4 rather, not percent, it's dollars. $4, this one $5, this one $4. The two is now $13. That's what you have for the day. So you go for the first one, you have break even. The next one, that is equal to net difference from your account is 0. You go for the next one and you risk $5, guys. You now have 1 to 6. You have 1:6, meaning that this 1:6 is 6 times 5. You risk $5, you get $30. Okay, $30. Okay, this $30, guy, you're going to add it to 231, guys. That is $261, guy. Okay, you're going to multiply it by 5. Okay, divide by 100. It's going to give you, let's say, it's giving you how much now? Let's say $17.
$13.
Eh?
13.
13.
That is 13. 13.
Okay, $13. Yeah. So which means this one will not be up to $13. But let's just go. We are just doing a model that you have to follow. Just understand the principle. Okay, so this $13, guy, that's what you are going to risk. So you cannot just risk it on one trade. You can divide it by 2, guys, because you are moving up in the ladder. So when you divide it by 2, let's say you are risking $7 per trade, guys. So this $7 per trade you are risking, not percent, $7. You now see that you now lost it. You lost $7. Oh, $7 lost. Like Euro AUD that I lost. First lost in how many weeks? 2 weeks or so. So this $7 that you lost, what are you going to do? You're going to minus $7 from 261. Okay, and the answer is going to be what? 254. Are you noticing something, guys? When you win, guys, it is either you have break even or you win big. Are you noticing? When you are winning big, 1:6. That is 1:6. 1:6 is 30 US dollar. So you're adding 30 US dollar to your account. But when you are losing, you are only removing 7 US dollar from your account, guy. So that is, you now understand the model now. I don't need to continue from here. You understand what I'm talking about now? That is why I told you something. There are 5 outcomes that will come from your trade. It is either you have small win, small loss, break even, big win, and big loss. These are the 5 outcomes that will come from your trade. Do you notice that in the model I have defined for you, all right? In the model I have defined for you, you are able to find small win there. Am I correct? You are able to find small loss there. I'm correct? You are able to find break even there, big loss there. You are able to find break even there. You are able to find, this is big win, this is break even, fine. Big win, fine. And big loss, fine. These are 5 outcomes you can have in a trade. I am telling you that the only condition that will make your account to grow, either small or big, is if you are able to eliminate big loss. And the only way you can eliminate big loss is by introducing the model of what? Maximum daily risk exposure limit into your trading system. Maximum daily risk exposure limit is going to ensure that when you win big. All right? When you win big. When you lose small. or you break even, and then you will never lose big. And then as much as you are not losing big, guys, your account will either grow little by little, or your account will grow exponentially. This is the logic, guys. This is how to do it. If you cannot eliminate big loss, guys, you cannot make it in this business. You cannot make it in this business. And I've told you, the only way you can eliminate big loss, the only way, listen to me very carefully, I have done it, it's working for me, and it can work for you. The only way you can eliminate big loss is by introducing maximum daily risk exposure limit. You don't risk the whole of, you don't expose the whole of your capital to the market. It has almost become an abomination. It is a taboo to have $1,000 account, and then per trade you are losing $100. Why will you lose 10% of your account in just one trade? It is an abomination. It is a taboo. It is even criminal. If that person is my student, it's a criminal. It's a criminal offense. The person the person should be banned from the group, because he's not a respecter of rule. You are not a respecter of rule. You don't have ideology. Your psychology is low. And sooner or later, we will take that person for psychiatric test, because we cannot be drumming something to your ears every day and you keep on making the mistakes. My account cannot fall drastically like that, because I have understood the concept of maximum daily exposure limit. Once you have exceeded that limit, you are off. But if you are winning and the limit is increasing, then continue to trade. But as soon as you hit another loss, that $7, $10 is going to, be deducted from your account, just you are positive for the day. Just close and face the next day. Is that okay now? So before I move to my analysis, if you have a question based on what you have done, just ask me now. Ask me the question and mute yourself. Ask me question before I move to the analysis.
Thank you, sir.
All right. Is it clear?
Very clear, sir.
Okay.
Just the one challenge is that sometimes,
yes,
like I pointed out clearly, that October, November, December, there are not so many wins in the trade.
Yes, sure.
I think that was where I had a big challenge then.
Okay, now let me tell you, mute yourself right away. Yes, it's a challenge.
Although my maximum daily exposure, I've had this lecture with you before.
Okay, just mute yourself. Let me talk now. All right. So now you see what he's talking is very clear, that the problem is that when market is not cooperating, that he kept on losing. This is what some of us we have grown past that level. Once you have identified the market not to be moving, he was saying that around October, November, December last year, he lost his money just because market was not moving. That is true. If as a professional trader, you have identified the market to be in consolidation mode, do not trade. Leave the market alone. Leave the market alone. It's not by force. You don't force it. As long as the market is not moving, it's not respecting analysis, it's flashing up and down, just leave it alone. We have learned to do that. Then when the market cooperates with you, you now continue. I think I told one of participants in this current webinar that I told him for like 2 weeks I did not trade. He said, why? He said, why? I said, because market is not cooperating. Market is consolidating. It's not doing the way it's supposed to do. And so once we have recognized it, we left it alone. Then when it's ready to cooperate, we go on. As a result of Russia-Ukraine crisis, the market was not doing what it's supposed to do. We left it alone. Instead of you to be wasting your money, forcing trade on yourself, you leave it alone. When it's ready to agree with you, you cannot continue. That is what you should do. So briefly, I've heard from Mr. Ambrose, I've heard from Ali Aim, I've heard from Emmanuel Uwudu. I need to hear, okay, Joy Jelisa was not trading with us yet. So let me not ask her a question regarding the update of the weekly trade we took. She did not take it with us. I don't know if Taufik was is in intermediate class. Are you in intermediate class? No. Taufik, are you in intermediate class? Taufik. So he's not here with us. To be Asa, you are not part of intermediate class yet. I know. All right. So now, for that reason, I cannot ask you any challenge as per the trade that we took in the week. But once you join us, definitely I'll be asking you such a question. So let me go straight to the trade that we took in the week, and so that we can analyze them. So after this program, I'm going to process this video and upload to YouTube. Make sure you watch and watch and watch, especially the risk management strategy. When you get that risk management strategy and you master it, you can trade for profit conveniently. All right. So let's go to the trade that we took in the course of the week. We took GBP CHF. Okay. We took Euro card. We took Euro odd. Which one did you take again? Can anybody remind me? What did you take again? I took gold, but I did not give it.
CAT CHF.
CAT
Catch
CHF.
CHF.
Oh, good. I took gold, XAU USD, but I didn't give you. You know why I didn't give you? Because your account
Because
is
he's
small.
golden.
Because I know you guys' account are very small. I don't want to give you good. And then I also give you CAT CHF. CAT CHF. All right. So we are going to be analyzing these pairs one after the other. Is there anyone again that I did not remember? These are the trade we took in the course of the week. All right. So let's start from GBP CHF. GBP CHF. Where is it? All right. Yeah. All right. Yes. GBP CHF daily. All right. Remember, lest I forget, I've started producing video on Elliott wave theory as a form of technical analysis. I've done part 1, I've done part 2. All right, I'm going to do part 3, part 4, part 5 before Monday. So next week or tomorrow, I'll start releasing them one after the other. Once you study one, the next day I release the next one, the next day, so you can be watching it repeatedly until you get the concept. Okay. It is Elliott wave theory that we use in getting all this direction. We are not just deciding. You notice that when we say this is how the market will behave, that's how you see it. It's nothing but Elliott wave theory. Okay, so if you look at this session here, what do you see here, guys? You are seeing impulse. What you see here is an impulse. So in the video that I'm producing now, when you study the first part there, you are going to understand. I think the second part is on impulsive wave, motive wave. You are going to understand what this one means. After this one, you are expecting a correction. And that correction must be in 3 waves. 1, 2, and 3. Can you see? 1, 2, and 3. So these 3 waves you see, hold on. Let me do the schematic for you to understand. In every impulse you see here, you see like this. Impulse means a very sharp and fast move, either to the upside or to the downside. There must be a correction. Okay? And after the correction, there will be the next impulse. Do you understand now? So this one, you see, there's an impulse. It's going to be very sharp and very fast and very strong. And then this correction you see is going to be very slow, and usually in 3 waves. Okay, in 3 waves. And then you see the last push, continuation to the upside. Do you understand now? So now, what happened is this. These three waves in the middle here, these three waves in the middle here is labeled A, B, and C. This is A, this is B, and C. So you now see that even within the corrective structure A, B, C, you see A on its own is called impulse. Impulse. Okay? B is called correction. Correction. This is impulse. What's happening? The mouse will not focus today. C is called what? Impulse. Do you understand now? So now, what do I mean by all this that I have told you? What do I mean? Look at this A here will be very sharp. This B here that goes up here will be very slow. And this C here will be very sharp. So after that, you now expect this will be a knot that combine these two planks together. Do you understand? Now, this schematic that I just showed you, now come and look at it here. This is the first impulse. This is the first impulse. Impulse, boom. After that impulse, what do you have? The next thing you have, you need a corrective structure to the upside. And you now have this one push, and you now, that is A. You now have 1, 2, and 3 that I show you in the middle. That is B, and you have this C. So in the group, immediately I saw this. Immediately I saw this push up. I know this is wave A. And I saw this three-wave structure down. I know this is wave B. Immediately, I just gave you this stuff. Boom. Not this, not this. I gave you this. Boom. I told you this wave is coming here. Is that not? Can anybody bear me witness? And I traded this. Boom. To the upside. Why did I know that this is going to make a boom to the upside? Because this is in line with theoretical guideline. Let me go to 4 hours so that you can get it clearer. This is in line with theoretical guideline that if we have a strong impulse to the downside and we have wave A that is very sharp, then I told you this is where your fib retracement of 61.8 is not going to work. Because immediately I see a sharp move here, I already identify it as wave A. All right. And then if I have wave A, I must have a three-wave structure that will make a wave B. That is the bolt and knot that is connecting the two. And once I have this wave B, equivalent of this wave here, I must have it here. Okay. Can you see? That is wave A, wave B, and wave C. Immediately I complete it here. It means that this move to the downside has been completed, has been corrected. And I told you in one of my videos that in that case, you should be expecting up to 78% retracement, guys. What do you see here? You click, you have just met the condition of 78% retracement. All you see here is the fake out that I keep on telling you. This is the fake out to make people to continue to buy this to the upside. But some of us that are very smart and know what we are doing, we know this is just to grab liquidity as supply, and the next move is to the downside. Do you understand? So all this I have explained to you now is Elliott wave theory. You are going to get it when I release those videos on Elliott wave theory. All right. So after this corrective structure, you expect this move here, you see here, you expect it to come to this place. And that is the continuation move. Do you understand? And now watch what happened. So as soon as we got to this place, we were ready for the sell. Let's go to 1 hour. Okay, I remember we caught the sell from here. We caught the sell from here, sell. The market sold to this place and gave this structure. We sold again. All right, the market now came here. And when we saw this three-wave structure, remember what I told you? This is sharp, this is sharp. So this one become wave A, this one become wave B, this one become wave C. So I saw a possibility of another move to the upside to break this top. And at that point, at this level, we enter, myself and my intermediate traders. So when we got our profit up to this point, I told everybody close, because this is a resemblance of a three-wave structure. We are likely to go to break the top. So as this strong push to the upside was going on, and we saw this move, after this move, a wave that's supposed to break to the upside is not supposed to develop this strong bearish impulse. It was at that moment that we discovered that this move to the downside is not negotiable. And at that point, we got in here. Sell. And that was how we caught about 150 pips to the downside. All right. That was only a massive trade for the week. I think we close here. Close here. Yes, at this consolidation, about 177 pips to the downside. Okay. So we close it. And at that point in time, I sent a message again that you have a consolidation that result to the push to the upside, and that is this consolidation here that result to this one grabbing liquidity. And once this one has fallen to break the low of this liquidity, guys, you don't need to start selling the next day. Expect a corrective structure to what I told you. Expect a corrective structure to about 50 to 61.8 of this push, and then 50 to 61.8 of that push will give you this. I think you can see that all you learn in the foundation class, you are seeing me applying them one after the other. You are seeing, I mentioned Elliott wave theory for you. I'm applying it. I mentioned Fibonacci theory for you, and I'm applying it right here. So you see 50 to 61.8 is here. It's here, guys. Excuse me. Look at it here. So you are expecting this market to come here. I'll have to change to my color, yellow. Okay. You are expecting it to come here. So it was when we were here. When we were here, guys, it was when we were here, I said close. This market will retrace to 61.8. But when this one was coming, I want to believe that some of our guys will be thinking, this thing is still selling. Why don't we just sell? No, I said it's a rule that I have defined for myself. Once this market has broken below this consolidation that caused it, you don't sell it again. Leave it, it's going to come back. So now watch, they are going to be having this move. If this market is going to sell, it's going to get to this place. Normally, it might form consolidation here, break to the upside to catch liquidity, just as it broke to the upside, catch liquidity, and then you see this supply zone to fall from here. Because why am I anticipating a fall from here? Look at it, guys. I'm going to show you something. Do you see this wave, guys? You see this wave? You see this correction? I must see equivalent of this wave here. This one has not effectively broken this low. So I want this one to form a three-wave structure and break this one very clearly. As soon as it breaks it clearly, we'll be looking for buy opportunity to the upside again. Do you see how we plan our trade? It's so simple, guys. That's how we plan it. And if it doesn't work out, if it doesn't come to where we want it to come, we are not going to touch it. We'll be looking. And then let me now show you how to get a valid supply level. You don't just take a fib anyhow. This is the 61.8, 50 to 61.8. What do you have to do, guys? Let me clean up this. You now check the left. Check the left-hand side. When you touch the candle, ask yourself, within this range of this candle that you see here, how many green candle, how many buy candle do you see here? Somebody should answer me, or mute yourself and answer me. How many buy candle do you see here in the level that is corresponding to none? You are seeing a very
total supply.
Correct, a very powerful candle. In the record of the bank, guys, they are recording this level. They are not recording candlestick here. What they are recording here is price in their books. They are recording here between this price 1.2300 and 1.2280. Everybody was selling. Nobody was buying. That is the record they have. So when market gets to the corresponding level, bank algorithm is going to pick it that at this price, people were selling, and some people who have seen bank record that people were selling at that level, they want to wait until price get to that level so that they can join this air. So this is a premium price. When you want to sell at a higher price, you are targeting a premium price. When you want to buy at a lower price, you are targeting a discounted price. Do you understand now? I don't want to do counter trend. If not, I could have given you buy opportunity here. Buy. But I don't want to train somebody to start doing counter trend. What do I mean by counter trend? This is a bearish market. Why do I give you a buy in a bearish market? Okay. So now, once it gets here, we're expecting this market to get here by next week, by Tuesday or Wednesday or Thursday. We're expecting this massive fall again. This fall is going to resemble this wave, guys. So if you couldn't caught this one, make sure you get ready to catch this one next week. All right. So that is for Euro, GBP, CHF. What's the next one? CAD yen. CAD yen. CAD yen. Where's CAD yen there? All right. CAD yen. You see, CAD yen, if you remember vividly, I gave you the analysis of CAD yen that at this level, guys, CAD yen is going to move to the upside. But you remember the structure I always taught you: push, correction, push, correction, push, consolidation, push, and then come down. This is a structure, a perfect structure, okay, that banks use. I've printed it for you guys, and that is how it is. Look at it here, guys. Look at it here. 4 hours. 4 hours. Can you see that this market has bought so much? It has bought so much that it needs to go down. You need to do what? You need to go down. Let me show you. Okay. You need to do what? You need to go down. So now you have this consolidation here. And then after that, you have this move, correction, move, correction, move. What do you notice? Are you seeing that it's making a small move? It's correcting. It's making a small move. It's correcting. Why is it not making a big move, guys? Why is it making a small move and it's correcting? It's telling you that the move to the upside is getting faded away. That's what it's telling you. It's getting faded away. So in that case, we have to expect a move to the downside. And what happened? Boom. See this move? Came down, broke this low. Boom. At this stage, I knew that we are going to come to the downside. And what did I do? All my students in the intermediate class, somebody should mute himself at this level. What did I do to you? Because the market was retracing at this level, guys. It was retracing at this level. What did I do to you? I sent a markup to you and I told you, what did I say you should watch? What did I say you should watch? That's how to learn.
50 to 61.8%.
Correct. I did a fib like this and I marked this level of 50 to 61.8%. I marked this level. I said the market is going to get here. Okay, as soon as the market gets here, we're going to be ready for a sell. And I look left. What did I teach you? I say as soon as you get 50 to 61.8, look left. Do you see pure supply? Yes, there is excess supply over demand, guys. Excess supply over demand at the corresponding level. That is a confirmation that this move will come. And again, what is the candlestick you are seeing here? This is a selling pressure. The market goes to the upside, deceive people, grab liquidity, and then fall down. And then again, I also taught you something this week that in this video, that a corrective structure will come in 3 waves: A, B, and C. So if you are saying A, B, C with equal leg of A or C coming to 61.8, and you are saying this rejection is an indication of massive move to the downside. And then at that level, I place my trade, get in, boom. And what do we see? The market is down here to the downside. So what are we expecting again next week? Take a fib from this impulse to this leg, look for 61.8. Where's 61.8, guys? 61.8 is right here. 50 to 61.8 is right here, guys. It's right here. But there's something I noticed with experience, that anytime you have a little buy here before you have this move, this market is not going to fall exactly at the same level, guys. Pay attention to me. Pay attention to me, because I'm telling you the market as it happens raw. I'm telling you what nobody will tell you. I'm telling you what you may not get in YouTube. All right. I'm telling you what, if you Google it, you may not get it. Because some of these things I'm telling you is based on my experience. The market is not going to sell at the same level that 61.8. Why? Because you are having an equal high here. So there is tendency for the market to take off this equal high, to take liquidity at the main supply before it falls. So how do I mean? You are going to see something now. Watch out. You are going to see move, correction, move, correction. At this level, guys, the market may give you consolidation. May give you consolidation, fly up to the upside. Why is it flying up to the upside? Look at excess supply over demand residing here. Boom. Boom. Do you see this candle? See this candle before this big one. See the next one that developed before that big one. That is your supply. The entire area here, guys, is your supply area. This is your supply zone. So when you hear people tell you supply zone, supply zone, supply zone, some of them will come and say, up here, the supply zone, up here, the supply zone. They don't know what they are doing. This is the supply zone, guys, because the supply zone is a zone where you have excess supply over demand. And when you trace the market to the left, you're going to see it depicted in the size of the candlesticks. It's going to appear in the size of the candlesticks. That is the supply level, guys. Okay? And from this level, we're expecting this market to make a move to the downside. Okay? In the size of this move, we're expecting it here, guys. Move to the downside next week. So I'm giving you trades for next week. What's the next trade we took, guys? Eurocard. Let's go to Eurocard, guys. Eurocard. Okay? Eurocard. So I believe all of you knew in the group that we forecasted this move, right? When this move was here, we forecasted it, okay? And we said we're going to get this move to the upside. Is anybody in the group, is anybody here knew when this was forecasted? Even up to this correction level, I forecasted it. This correction level. Here, I told you the market is going to do this. It's going to do this. I told you this market will move here. It will correct here. It will move here. The only thing I did not forecast is consolidation here. It will fly up and fly down. Instead, the market did not consolidate and it was coming correctively. So that was why. Because we did not see this pattern, that was why we missed this trade to the downside. But then, as it got to this same level here, we now said, okay, we have gotten to equal low here. Good. This is support and this is demand. But mind you, when you have equal low here, the market is not going to move boom to the upside. No, it's just telling you that I'm just gaining momentum and I'm just gathering power. I'm gathering power. I'm gathering power. I'm coming to break it. This is what is called equal low liquidity. Somebody hearing me? This is what we call equal low liquidity. A market cannot form double bottom. You know, in your conventional, forex trading books, they will tell you where you come to. They say this is double bottom. All right. What they tell you is that they say this is a double bottom. I laugh. So this is double bottom. So buy from double bottom. This market is going to break this level. Go and write it down. It's going to break it. So that is why you see this move to the upside. It's not terrific. Okay, this move is not terrific, guys. Can you see it's moving slowly, 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 and slowly? Because it's not going to be powerful. It's going to come to this level. It's going to come to this level, guys. Let me do it very well. This is what I'm expecting. So that was why I told you not to close your trade, or because market is closing, I say you can now close it. Next week, we are going to trade this. See this move, correction, impulse, correction, impulse, correction. At this level, you are going to have consolidation. After that consolidation, you are going to break to get this top liquidity. And after that, you are going to make a move to the downside. Okay. I'm going to be trading this up move with you, and I'm going to be trading the down move with you. And at the end of the day, this is going to be a corrective structure, guys. Corrective structure, corrective structure, corrective structure. And then all this wave in the middle, this wave that comes here, I'm going to have a replica. Oh, sorry. This wave that comes here, I'm going to have a similar wave that comes down to the downside, meaning we have a lot to go. And you know, this downside is in line with our fundamental analysis. This upside is in line with our fundamental analysis. What does our fundamental analysis say? Our fundamental analysis says we must compare the interest rate between euro and CAD. Okay, CAD. The interest rate on euro is 0. The interest rate on CAD is 1. Okay, so 1% is strong. Many people want to buy the CAD, and many people want to sell the euro against the CAD. Everybody want to keep CAD. As a result, when you have euro CAD, it means if CAD is going up and euro is going down, then you are going to have this set. But this upside is a necessity to complete a structure for this set to come. So this is a structural requirement for us to have this buy. So somebody say, if fundamental analysis is saying we should sell, why are we buying? Yes, there must be an alignment between technical analysis and fundamental analysis. So even fundamental analysis says, yes, we should sell. You cannot just sell. You cannot take it just like that and sell. You must ensure that market comes up and give you a retail price, a premium price, to which you can sell to match, to align yourself with the fundamental analysis. Do you understand now? So this market must come to the upside, break this top, then we will get in and ride it to the downside. Do I give you an example? Oh, yes, Euro GBP. We took Euro GBP a week before last. Where is it now? Euro GBP, where is it now? Oh my God. Yeah. Okay. What's the alignment? The alignment says we should sell Euro GBP. Okay. But at that moment, where we decided that based on fundamental, we need to sell Euro GBP. Where was Euro GBP? Euro GBP was here. If some people sold here, if you're an investment banker, are you going to sell here for your customer? When there is opportunity for this market to go to the upside, you have to wait. You wait. We waited. This stock was broken. We have this consolidation here. I told you there's going to be a break to the upside to catch liquidity, and we have to have this move to the downside. What happened? Because this move to the downside is in line with fundamental analysis, that there is no way anybody in his right senses will keep buying euro against the GBP. Euro maintain interest rate of 0% and GBP increase interest rate from 0.7 or 0.75 to 1%. So everybody, every investor is keeping GBP and they want to sell euro in order to buy their GBP. Do you understand now? So this is just the trick, guys. And as soon as we get here, as soon as we got here, we barely broke the low here. We have the corrective structure. We did not take this trade, but I told you, expect a correction. And in the Elliott wave theory package I'm doing, make sure you study it, because as I'm seeing this pattern here, guys, watch. As I'm seeing this pattern here, this one here, I already know what the market is doing. I already know what the market is doing. This market is doing what is called Wxy structure. It's going to be in the series of Elliott wave theory course I'm packaging for you. This is a Wxy structure. What's a Wxy structure, guys? The Wxy structure is when you have an impulse, you have 1, 2, and 3. You have 1, 2, and 3. The next move is 1, 2, and 3. This has effectively corrected this big impulse to the downside, and the next move is downside. Do you understand now? So this is called a Wxy structure. This is 3 waves up, W, 3 waves down, X, and 3 waves up, Y, and you have a downside. This impulse. So this is still a 3-wave structure, but in the form of 333, which we call Wxy. Look at it here. Look at it here, guys. I'm telling you raw what's happening in the market. Look at it. 1, 2, and 3. All right. So this is going to be a combination corrective structure. 1, 1, 2, and 3, 1. This structure is over. By next week, if you have this market comes down to this level, buy it to the upside. 1, 2, and 3. So this is what? W here. This is W here. This is X here. And this is Y here. So this structure, you now see that if you take the feed of this wave from here to here, guys, this Wxy structure is going to end at 50 to 61.8. And then if we end here and make a throw or overthrow here, overshoot here, where is the supply, guys? Where is the supply, guys? The supply is here. The supply is here. Can you see? Trace it to the left. This is supply. What do you see here, guys? Equal high. Equal high must be taken. And in equal high taken here, you have taken the supply here or taken the order from here. And after you have taken the order, what else? You sell to the downside in line with our fundamental analysis. That is why you see that we are not doing all this buy, but we are going to do this sell. Boom, to the downside. Can you see, guys? Can you see the importance of understanding demand and supply? The importance of understanding Elliott wave theory. When you blend Elliott wave theory, blend it with demand and supply, and I will teach you support and resistance. When you combine all these together, chart analysis will be a lot more easier. All right, so the next pair we are going to be analyzing right away is Euro up. Euro up. And first and foremost, I want to tell you the reason why Euro AUD is consolidating. Listen to me very attentively. You have Euro USD, EU. You have AUD, USD, AU. Okay? And then let me write it clearly. Let me write it clearly. I think the last one is good. We are going to analyze. So we're almost done, guys. We're almost done. All right. So we have Euro, USD. You have AUD, USD. Do you see, guys? So if you break it like this USD is common. What happened here, guys? What is left? Somebody should unmute this himself and tell me or herself what is left. What is
Euro
left?
AUD.
Correct. Euro AUD is left.
Euro AUD.
Correct, correct. So what is this? Euro AUD. So now listen to me very clearly. Anytime you have Euro USD is bullish, you have AUD USD is bullish. What does it mean? AUD USD is bullish. Euro USD is bullish. Bullish, bullish. What it means is that USD is weak, and then AUD is strong, Euro is strong. So you have two currencies that are strong. What is the outcome? Consolidation. If you don't understand me, talk now. AUD USD, in AUD USD was going up, was bullish. Euro USD was bullish. So it then means that USD was weak, AUD was strong. USD was weak, Euro was strong. And then when you now combine Euro and AUD together, you form Euro AUD. So you are combining two currencies that are very strong. together. Euro AUD rather, AUD. So if you combine two currencies that are strong together, they are not going to give you a push. They will give you consolidation. At the same time, if you combine two currencies that are weak together, they will not move against each other. They will give you consolidation. That is why this pair has not moved anywhere. You keep on going up, down, up, down, up, down, up, down, up, down, up, down. So we are going to get to a stage where I'm watching it. There's going to be a stage. Let's take this fib from here. Remember, guys, this push. Let me show you something. This push here, this is a corrective structure, guys. You are going to see it in my book or in my videos on Elliott Wave theory. This is running flat. You have this push, you have this correction. You have this push, take the fib of here, you have this correction up to even 78%. Okay, you are going to see how I taught you in that book, that in that video, that if you see a zigzag corrective structure, it's going to come to 78%. Guys, that lesson is crazy. That video is crazy, guys. I just watch it, guys. You understand some of these things perfectly. Okay, and then if you take a fib here again, from here, impulse to the end of impulse, what is this, guys? What is this? 50 to 61.8. So what I'm thinking is that the possibility of this market coming all the way is going to form this consolidation. First and foremost, I taught you something, guys, that when you see in an uptrend, when you see a market consolidating, it's going to flash up or flash down. Where is it going to go? Flash up or flash down. Where is it going to go, guys? Unmute yourself and tell me. Nobody knows the answer. You guys don't disappoint me.
I think it's going to go up.
If it wants to buy, if it consolidates, where is it going to go? Is it down or up?
It will go down. It will go down.
It has to go and pick
It will
liquidity.
go down.
Yeah, it has to go and pick liquidity at demand. That's what I have been teaching.
Demand.
Yes, go to come. So now this consolidation, we are not going to touch this trade again. This consolidation might do something like this. Just watch out. I want to show you something. You see this push? See this correction? You can see this push, and the market will flash down to pick liquidity here. Can you see? Pick liquidity here. And then on the way to the upside, to grab 1.5500 that I told you, this 1.00, I'm serious about it. And then you see that you are having a structure here. Okay, you're having a structure here. You notice that in this correction, you have 1, 2, and 3. Then you have 1, 2, and 3. You may expect 1, 2, and 3. This become, what structure is this? What do we call this corrective structure, guys? 3, 3, 3. What do you call it? I mentioned it this evening. 3 wave down, 3 wave up, 3 wave down. WXY, correct. This is WXY structure, guys. So you have W here, 3 wave down, you have 3 waves up, WX, and 3 wave down, Y. And at this level, what do you notice here? Equivalent area of demand. What do you notice here? You see any sell candle here, guys? You see any sell candle here, guys? Any sell candle here? Here?
No.
I see entirely demand. So this market may come here, pick liquidity at demand here, and you might see a whole number here, guys. Where is this guy? Where is this guy? 1.4700. 1.4700. This will be the likely area where we are going to pick order for this pair to the upside to break 5500. That's going to be about 700 pips to the upside, guys. Pick order from here, make it here. And as soon as we get there, why am I projecting here, guys? I've taught you this, that look at this high here. Don't miss this guy. Don't miss this thing, guys. You see this high here? This market is coming to break this top for it to have a meaningful sell to the downside. Okay, and in breaking that top, it has to catch liquidity at 55. And I now look at my 55 area. Do I see excess supply over demand? Yes. Where is it? Pick this 2, pick it here. This is 55. Pick it here. Pick another one about 4500, about 4500, 5400 to 55. I'm expecting this market to grab liquidity here and then make a move to the downside in line with fundamental analysis that euro has to sell against the AUD. But somebody will say, why are we buying? Why are we buying? Why are we buying? Because we are buying because we still have bigger room to the upside. Because if this wave to the upside does not come, we are not expecting this downside. Do you understand now? That is euro AUD. Last but not the least, guy, I'm going to analyze gold. Then everybody will go and rest for the night. I've stayed not, you know, I made it clear that I expect gold to come to 1800 before I will buy, but unfortunately, it came down from 1835. It came down to as low as 1807. Just 7 points to hit my buy limit. It did not hit it, and it make a move, and then I caught it right here. So I look at it. I took a fib of this to this, and then before I get to this, let's analyze from daily. Okay, I'm rushing so that everybody will go and sleep. We have spend time. All right. So let's analyze from daily. What did I teach you about corrective structure? I told you corrective structure is usually in 3 waves. It's usually in what? In 3 waves. This market is going in uptrend. You see this move to the upside. What do you see here? 1, 2, and 3. What validates 1, 2, and 3? In the middle, you are going to see a boat and knot, guys. And that boat and knot is going to be in 3 waves. You have an impulse, 3 waves in boat and knot that connect the two. Boom. So this is the plank. This one is the plank. This is another plank. And this middle here is the corrective structure. Do you understand now? And I told you when I was teaching you the other time that with A here, this with A, this with B, this with C. Okay? And I told you that this with A is sharp, with C is sharp, with B is sluggish. Can you see that this with B is sluggish? Can you see that this is sharp down, this is sharp down, this is 1, 2, and 3. So, and this 1, 2, and 3 has come to fib level of what? 61.8. Look at it here, guys. Raw. I'm telling you this thing raw. So after this, what do you expect? Boom. This has made equal leg. This A here and C here are now the same. This is equal legs. So as a result, I now told my guys in the group that the corrective structure for gold is over at this level. We should expect a move to the offside. Whether this wave will have to be corrective here for us to move down, or it has to go up to break this up, I don't want to know. At this level, wave gold must go up. And what do you see, guys? What do you see, guys? 4 hours. Can you see? It's going up already. All right, it's going up already. So you now see, we now have this move. Watch. See, this is the downtrend, 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 downtrend. What's this guy? Watch this guy. When you watch my video on wave one of an impulse, you are going to see that it is wave one of an impulse that break the resistance of the previous trend. Look at the resistance. It has broken into the downside. That means the downside is over. All we are looking for is correction to 50 to 61.8 and we'll make a move. Boom, to the upside. Now, take a flip from here to here. Where's this, guys? Where's this? What's this, guys? Where's this? 50 to 61.8. What do you do? Boom, to the upside. So when we come next week, what are we expecting gold to do? What we are expecting from gold is go to a smaller time frame, 15 minutes time frame. Already, I had a buy on gold today, but I did not give you. Why? Because I see this corrective structure. After this corrective structure, I see this strong push, and then I have to buy. But on Monday, what's going to happen is that because we are expecting gold to be bullish, it will not start the week bullish. What is going to happen is that, let me see time. Okay. Excuse me. So what are we expecting on Monday? What we're expecting is this. This consolidation should continue. break down to cash liquidity as supply. Is somebody getting this logic? Cash liquidity as supply and then move to the upside. That's all. Cash liquidity at demand rather, not supply. Cash liquidity at demand and move to the upside. That's what we are expecting from gold next week. All right. So this lesson tonight, I'm going to upload them. I'm going to upload it on YouTube. You can watch. You can watch it. You can get the content from there. If you want to watch, you watch, you watch and watch and watch and watch. But of course, I promise you that I'm going to analyze the trade of the week, tell you the theoretical concept. All these theories I'm telling you may not make too much sense to you right now, guys, until you go and study the entire course I'm putting together on Elliott wave theory. Once you study that Elliott wave theory course, guys, all this is going to make a lot of sense to you. Is in Elliott wave theory, you are going to know what this pattern is all about. This is what is called an expanding flat. Boom, to the downside. This is called a zigzag. Everything you see, this is called a regular flat. Okay, it's not Elliott wave theory. You are going to see the meaning of all this. Okay, this is a regular flat. It's simple, guys. So you are going to be seeing all this, and you know the reason why we are taking the trade, what we are saying before we take the trade. What makes the course to be very unique is because I have blend liquidity, I blend demand and supply, I blend smart money concept, I blend everything together with Elliott wave theory to form a complete package for you. Okay, so that will be where we'll put a stop today. I'm going to pause the recording so that I can give you room to ask a question. So I encourage whoever has not subscribed to my YouTube channel, just if you like the content I'm putting forward, please subscribe to it. Make your comments known. Whatever video you want me to produce for you, please do tell me. I will definitely produce it within 48 to within 3 days to 1 week. I will definitely produce the video for you. Make sure you comment there. Make sure you share the video with your friends and colleagues, and make sure you also like. All right. Thank you very much.